Good morning. This is Conrad Kowalski, and I'm with Excalibur Financial Services, a wealth management and financial planning firm here in Jacksonville, Florida. And this is our weekly market recap where we go over the performance of areas of the economy from last week, ended Friday, November the 4th of 2016. As always, most of our data is provided by JP Morgan Asset Management, and we thank our partners for providing that to us. This is the overview, but as always, we're going to zoom in on each section so you can see it a little bit better. And the first area to discuss is going to be the U.S. and international equities markets. In other words, how did stocks do last week? Well, it is unfortunate that stocks actually had one of its worst streaks of losses, 9 consecutive days, and it was the worst since December of 1980. All that being said, for the week, the U.S. market was down about 1.89%. International developed was down 1.55%, and emerging markets down about 2.57%. Out of all those, year to date, the best performer is still emerging markets, and the only negative one is the MSCI IAFI, which is the international developed. One interesting thing to note, while it's down 1.44% for the year, the dividend yield on stocks, international developed stocks, is 3.28%. So one could certainly offset the other. Even though you have a price performance that's negative, you could still make money due to the higher yield. Going on to fixed income or bonds, traditionally when we see a drawback on the U.S. and international equities markets, we see an increase in the demand for bonds. We certainly did see that. If we look at the U.S. aggregate, corporate, and municipals, they were all up for the week. And then if you look to the lower part of this chart on the left side, you can see that rates fell, and rates always fall as the demand for the bonds increases. They have an inverse relationship. Another reason for the demand for U.S. Treasuries is not just a flight to safety from stocks, but also with the Bank of Japan, the European Central Bank, and the Bank of England all keeping their rates either negative or close to negative. Investors are looking for a safe place to put their money where they can get some yield, again increasing the demand for U.S. bonds. Now, if we take a look at what's upcoming in this week, well, actually, let's take a look first at what happened last week as far as data. Core PCE. What is PCE? It's the Personal Consumption Index. This is similar to CPI, the Consumer Price Index, in that it measures inflation, but it is released by a different department of the government, not the Department of Labor, and it traditionally, over historical, it has been lower than CPI. So if you see a PCE of 1.7, then perhaps CPI is closer to 2 or something like that. But it's good to see some positive inflation, as that's one of the things that the Fed is looking at in raising rates, and we are of the opinion here that the Fed kind of needs to reload its gun and increase rates. So if we do have another financial crisis, or when we have one, they'll have some ammunition to lower rates and stimulate the economy again. Not only that, this environment we're in of ultra low rates is decreasing the returns on both stocks and bonds. And overall, just for investors, we're seeing returns of 4, 5, 6% rather than 7, 8, 9% annualized. But back to some more good news. Manufacturing PMI index increased to 53.4. As I discussed, the FOMC, the Federal Open Market Committee, in other words, the Fed, left rates unchanged. They have another meeting in December. The market is pricing in an 80% chance that they will raise the rate by 0.25%, 25 basis points. Again, we're of the opinion that should be done, and hopefully it does happen sooner rather than later, and that we'll see some continued increases during the year next year. Those are estimated to be anywhere between 50 and 100 basis points. Most bond market participants seem to believe the 50 basis point in 2017 increase estimate. And then last of all, the economy added 161,000 jobs last year. or I'm sorry, last month, and the unemployment rate fell to 4.9%. Great news. That means the labor market's tightening. I continue to talk about when that happens, the competition for employees grows, which means wages get pushed up, which will then help consumers to feel more confident spending rather than saving. And as we've talked about before, consumer spending is really one of the number one drivers of our economy here, so we do need that to increase. Week ahead, job openings. Again, the more of those there are, the further wages will be driven up because there's more opportunities for people to move, and employers will have to raise wages overall to retain and attract new employees. Consumer sentiment, again, important. Consumer economy here in the United States, and the U.S. presidential election, which has been blamed much for upsetting the equity markets last week. So hopefully once we have a definite result, we'll have a little more certainty in the markets. We're certainly not going to make any political statements here of one way or another. If you have any questions, you'd like us to help manage your investments, or just a no obligation, no cost analysis of your entire financial situation, we are here. Please contact us. You can call at 904-619-5944. You can go to our website, www.excaliburfs.com. We also have a blog on there where these videos are also posted to, in addition to our YouTube channel. And the founder of the firm, Gary Marsh, has been doing this for 35 years. Myself, I've been in the industry for 12 to 13 years, and we have some other great, well-trained, highly licensed staff, and we can certainly help you look at your finances from a holistic point of view. Thank you, and make it a great week.